You are staring at the stock market tickers flashing green and red, believing they are the heartbeat of the economy. But today, on December 4th, 2025, I am telling you that you are looking at a decoy. The next crisis is not going to start with a crash in Nvidia or a sell-off in the S&P 500. It is going to start in a dark, windowless room where trillions of dollars change hands without a single regulatory filing and without a single price printed on a public exchange. We are standing on the edge of the shadow banking precipice, and the ground is already crumbling under our feet. I have spent the last 48 hours tearing apart the credit agreements, the distressed debt memorandums, and the obscure Form PF filings that hedge funds submit to the SEC in secret. What I found is a mechanical failure in the plumbing of the global financial system that makes 2008 look like a dress rehearsal. Welcome to the investigation into the private credit bubble and the repo market seizure. Before we descend into this opaque underworld, I need you to lock 3 doors in your mind. 3 specific questions that we will not answer until the final seconds of this broadcast. Door number 1. What is the specific silent trigger that forces a liquidation in a market that claims it never sells? Door number 2. Who is the patient zero in this contagion? Because it is not a reckless bank, it is an institution you trust with your life savings. And door number 3. What is the ghost metric that leads the Federal Reserve to believe the system is safe right up until the moment it implodes? Keep those doors locked. Let us start with the cold open. The narrative on CNBC is that the economy is resilient because corporate defaults are low. That is a lie. Defaults are low because they have been redefined.
I'm looking at data from a major credit rating agency that shows a 400% spike in, quote, distressed exchanges. This is where a company cannot pay its debt, so the lender agrees to take a haircut or delay payment just to avoid marking the loan as a default. It is accounting fraud legalized by desperation. The entire private credit market, which has grown to $2 trillion, is built on this extend and pretend mechanic. But why does this matter to you? Because this debt is not held by banks. It is held by your pension fund, your insurance company, and your endowment. When this breaks, it does not break Wall Street, it breaks Main Street retirement accounts. Drop a comment right now, one word, safety or growth. What are you prioritizing in your portfolio today? Let me know below. Now, let us peel back the first layer of evidence, which is the liquidity mirage. In the public stock market, you can sell your shares in a microsecond. In the private credit market, there is no exit door. These funds usually have lockup periods where investors cannot get their money out for 5 or 7 years. But here is the anomaly I found in the fine print. Many of these funds offered quarterly liquidity to attract retail investors. They promised you could get your money out every 3 months. But in the last week, 3 major funds have raised the gate. They have suspended redemptions. Why? Because the requests to withdraw cash exceeded the cash they have on hand. This is a classic bank run, but it is happening in slow motion inside the funds that were supposed to be immune to volatility. The managers are marking their assets at 99 cents on the dollar, telling you everything is fine, while in the secondary market, those same loans are trading at 70 cents.
This gap is the valuation air pocket. You can understand this in 30 seconds. Imagine you own a house and you say it is worth $1 million because you refuse to sell it. But your neighbor with the exact same house just sold his for $600,000. You are technically insolvent. You just haven't admitted it yet. That is the state of $2 trillion of corporate debt right now. Now, let us go deeper into the payment in kind or PIK trap. This is the smoking gun. I analyzed the loan structures of the top 10 private credit deals done in 2021. Back then, interest rates were 0. Now, rates are 5%.
The companies cannot afford the cash interest payments, so the lenders are allowing them to pay in kind. This means, instead of paying cash, the borrower just issues more debt to pay the interest. The loan balance gets bigger every month. It is a negative amortization spiral. The lender records this phantom interest as income and pays themselves a bonus on it. But no cash actually moved. It is a hallucination of profit. I found one software company whose debt load has increased by 30% in 2 years purely from PIK interest, without borrowing a single new dollar for operations. This is a Ponzi scheme structure, where the existing debt pays for the new debt until the maturity wall hits. And the maturity wall is hitting in January 2026. But the contagion does not stay in private credit. It jumps to the repo market. This is the most complex and dangerous part of the investigation. The repo market is where financial institutions trade collateral for cash overnight. It is the circulatory system of the market. If repo stops, the heart stops. Right now, the repo market is flashing red. The cost to borrow cash overnight secured by treasury bonds has spiked.
This tells us there is a, quote, collateral shortage. You might ask, how can there be a shortage of collateral when the U.S. government is issuing $2 trillion of debt a year? That is the paradox. There is plenty of debt, but there is a shortage of pristine collateral that is not encumbered. Hedge funds have leveraged up their treasury holdings to the maximum to chase tiny returns in the basis trade. The basis trade is where you sell a treasury future and buy the cash bond to capture a tiny spread. To make money, you have to use 50-to-1 leverage. This creates a massive demand for repo financing. I tracked the net repo position of the primary dealers. It is at an all-time high. They are lending out every spare dollar they have. If the private credit bubble bursts and those investors need cash, they will pull liquidity from the system, forcing the repo rates higher. This forces the hedge funds to unwind their basis trade. When they unwind, they have to sell billions of treasuries instantly. This causes yields to spike, which crashes the stock market. It is a chain reaction that starts in a small office in Connecticut and ends with a margin call on your brokerage account. The basis trade is the dynamite, and private credit is the match. And this brings us to the skeptic corner. I know what the bulls are saying. They say, the Fed knows this. The Fed has a facility to backstop the repo market. That is true. It is called the Standing Repo Facility. But here is the clue that destroys that safety net. The facility only accepts high-quality collateral. It does not accept distressed corporate loans. If a private credit fund blows up, it cannot go to the Fed. It has to sell assets in the open market. But who buys a distressed loan in a crisis? Nobody. The bid is zero. So the contagion spreads to the only assets they can sell, which are their liquid hedges, like the S&P 500 futures. This is why the crisis won't start in stocks, but it will end there.
Stocks are the ATM that everyone rushes to when the credit window is nailed shut. Now let us look at the lender-on-lender violence. This is a new phenomenon that signals the end of the cycle. In the past, creditors worked together to save a company. Now they are eating each other. I found court filings involving liability management exercises, or LMEs. This is where a company teams up with one group of lenders to strip the assets away from another group of lenders. They move the intellectual property into a new subsidiary and borrow against it, leaving the old lenders with an empty shell. This destroys trust in the legal framework of debt. If a contract means nothing, then the risk premium is infinite. We are seeing major loans trade down 20 points on the news of these LMEs. It tells us that the recovery rate in the next recession will not be 40 cents on the dollar like history suggests. It will be 10 cents, or zero. And that brings us to the insurance companies. These are the giants holding the bag. In the search for yield, insurance companies have allocated massive amounts of capital to structured credit and CLOs, collateralized loan obligations. A CLO is a robot that buys risky loans and packages them into bonds. The top slice of the CLO is rated AAA. It is supposed to be safe.
But I looked at the underlying assets of the recent vintage CLOs. They are stuffed with the same PIK loans and covenant light loans we discussed. If the underlying loans default, the AAA rating is a lie. But the insurance companies hold these assets at par value on their books. If they had to mark them to market, they would be technically insolvent. This is why the regulators are terrified. They are proposing new capital rules specifically for insurance companies' exposure to private credit. This regulation itself could be the trigger. If they are forced to sell these assets to comply with new rules, they crash the market. It is a regulatory forced liquidation. We saw it in the UK pension crisis, and we are about to see it in the US insurance sector. Now let us pivot to the commercial real estate link. Private credit funds lent heavily to commercial real estate developers who couldn't get loans from traditional banks. We talked about banks having bad real estate loans, but the private credit exposure is even worse because they took the riskiest projects. Construction loans, bridge loans, mezzanine debt. These are the first to get wiped out. I found data showing that 60% of the bridge loans issued in 2021 are now past their maturity date. They haven't been paid back. They are just sitting there in limbo. The lenders are not foreclosing because they don't want the building. They are praying for a rate cut. But as we established in previous investigations, a rate cut doesn't fix a solvency issue. The building is empty. The value is gone. The loan is a zombie. And now we have to talk about the retailization of this toxic waste. Wall Street is smart. When they know the music is about to stop, they sell the chairs to the retail investor. We have seen a flood of interval funds and non-traded REITs marketed to doctors, lawyers, and retirees. They pitch it as exclusive access to institutional investments. It is not exclusive access. It is exit liquidity. They are selling you the assets that the smart money is dumping. I tracked the flow of funds. Institutional investors are reducing their exposure to credit, while retail inflows are hitting record highs. This is the ultimate contrarian signal. When the little guy buys the top, the crash is imminent. The marketing brochures promise 10% yield with low volatility. That is mathematically impossible in a high-rate environment, without taking on catastrophic tail risk.
You are picking up nickels in front of a steamroller, and the steamroller is the great deleveraging event that wipes out the equity layer before the debt is even called. Now let us look at the mechanics of the basis trade, because this is the nuclear reactor core that is melting down while everyone watches the stock market. The basis trade is an arbitrage strategy used by the largest hedge funds in the world. They sell a treasury futures contract which trades at a higher price, and they buy the actual cash treasury bond which trades at a lower price. They pocket the tiny difference between the two. Because the difference is so small, maybe only a few pennies, they have to use leverage to make it worth their while. I am talking about 50-to-1 leverage. For every $1 of their own money, they borrow $50 from the repo market to buy bonds. This trade has grown to nearly $1 trillion in size. It creates a massive artificial demand for treasuries, which helps the US government fund its deficit. But here's the trap. The trade only works if the cost of borrowing cash in the repo market stays low and stable. We just saw the repo rate spike. When the cost of borrowing rises, the profit margin of the trade vanishes. The hedge funds are then forced to unwind. This means they have to sell the cash bonds and buy back the futures. When you have $1 trillion of selling pressure hitting the bond market at once, yields explode higher. And as we proved in previous investigations, when yields explode, stocks crash. This is the hidden link between a boring arbitrage trade and your 401k. The regulators know this. The SEC has been trying to force these funds to clear their trades centrally, which would increase their costs and kill the trade. The funds are fighting back, but the market is already voting. They are deleveraging ahead of the rules. This pulls liquidity out of the system exactly when we need it most.
And now let us identify door number 2, the patient zero. It is not a bank like Lehman Brothers. It is the multi-manager hedge fund complex. These are massive platforms that employ hundreds of separate trading teams. They operate with strict risk limits. If a trader loses 5%, they are fired, and their position is liquidated instantly by an algorithm. There is no human emotion. There is no wait and see. This creates a liquidity cascade. If one pod blows up, it triggers automatic selling, which pushes prices down, which triggers the next pod to blow up. These firms are now so large that they effectively act as shadow banks, but they have no access to the Fed discount window. They are the whales in a shrinking pool. I tracked the correlation between these funds' returns and the broader market volatility. It is dangerously high. They are all crowded into the same trades: long AI stocks, short rates, and long credit. When one trade fails, they all fail. This brings us to the pension fund trap. This is the tragedy of the situation. Public pension funds, which manage the retirement money for teachers, firefighters, and police officers, are the biggest investors in these private credit and hedge fund strategies. They assumed an annual return of 7.5%. To get that in a zero-rate world, they had to take massive risks. Now those risks are coming home to roost. I call this the denominator effect crisis. Here's how it works. A pension fund has 60% in stocks and 40% in private illiquid assets. If the stock market drops 20%, the value of their public portfolio shrinks. Suddenly, their private assets make up 50 or 60% of the total pie because the private assets haven't been marked down yet. They are now overweight illiquid assets. Their investment mandate forces them to rebalance. But they cannot sell the private assets because the gate is down. So what do?
They are forced to sell the only thing they can sell: the stocks. They sell the S&P 500 right at the bottom to pay out benefits and rebalance their portfolio. This turns a market correction into a market crash. The pension funds become forced sellers of quality assets to prop up their zombie assets. This is the feedback loop that the algorithms are trying to front-run. And this leads us to the Japanese connection. You cannot understand US liquidity without looking at Tokyo. For 20 years, Japan exported capital to the rest of the world because their rates were zero. This was the carry trade. Investors borrowed yen for free and bought US tech stocks and corporate bonds. But now in December 2025, the Bank of Japan is normalizing policy. They are raising rates. The yen is strengthening. The carry trade is unwinding. We saw a preview of this in August 2024, but that was just a tremor. The real quake is happening now. Trillions of dollars of capital are being repatriated back to Japan. This sucks liquidity out of the US system. It removes the marginal buyer for our debt. And remember, the US government needs a marginal buyer every single week to stay solvent. If Japan steps away, the US repo market freezes. It is hydraulic pressure. If you close the valve in Tokyo, the pipe bursts in New York. Now let us look at the corporate cash burn. The bullish narrative says that corporations are flush with cash. I pulled the balance sheets of the Russell 2000 companies. If you exclude the top 10 tech giants, the rest of the index has the lowest cash-to-debt ratio in a decade. They burned through their buffers. They are running on fumes. And now the tax bill is due. The corporate tax cuts from 2017 are expiring. The effective tax rate for these companies is about to jump. At the same time, their interest expense is doubling. This is a pincer movement on profitability. Lower margins mean lower earnings.
Lower earnings mean defaults. Defaults mean the private credit collateral is worthless. It is all connected. And here is the ghost metric from door number 3. It is net liquidity velocity. The Federal Reserve looks at the total amount of reserves in the system and says, look, there are $3 trillion in reserves. The system is flush. But they are ignoring velocity. Velocity is how fast that money moves. Right now, velocity is collapsing. The money is hoarding. Banks are hoarding cash because they are scared of the regulatory capital rules. Money market funds are hoarding cash at the Fed's reverse repo facility, or what is left of it. The money is there, but it is not moving. It is trapped. A system with high reserves but zero velocity
is like a car with a full tank of gas but a broken fuel pump. It does not run. The Fed is looking at the gas gauge and telling you the car is fine. The market is trying to start the engine and hearing it sputter. This brings us to the ETF liquidity mismatch. We have created a monster in the form of corporate bond ETFs. These funds promise instant liquidity to retail investors, but they hold assets that trade by appointment only. In a panic, the ETF price decouples from the net asset value. The ETF might trade at 80 cents, while the underlying bonds are theoretically at 90. Arbitrageurs usually step in to close this gap. But in a liquidity crisis, the arbitrageurs are the ones dying. See the basis trade. So nobody steps in. The ETF price creates a new reality. The bond market reprices to the ETF, not the other way around. This is tail wagging the dog. We are seeing huge outflows from high-yield ETFs this week. This is the smart money getting out before the gates close. Drop a comment below. Do you own any bond ETFs? Yes or no? And do you know what is actually inside them? Now let us talk about the role of the central clearing parties, or CCPs. These are the entities that stand between buyers and sellers to guarantee trades. If a major member fails, the CCP has to absorb the loss. I looked at the default fund levels of the major clearinghouses. They are woefully undercapitalized for a systemic event. If a major hedge fund fails and blows through its margin, the CCP calls on the other members to put up cash. This spreads the contagion instantly to healthy firms. It is a mutualized suicide pact. The regulators have pushed everything into CCPs to make the system safer, but they actually just concentrated the risk into a single point of failure. If the CCP wobbles, the Fed has to print. There is no other option. And this is why the pivot everyone is waiting for will not be a celebration, it will be a rescue operation. The Fed will not cut rates because inflation is low, they will cut rates because the plumbing has exploded. And historically, when the Fed panic cuts, the stock market drops 30%. It does not rally. The rally happens 18 months later. The drop happens first. We are standing at the top of the roller coaster, and the safety bar just clicked open. The silent trigger from door number 1 is the intraday margin call. In the old days, margin calls happened at the end of the day. Now, with real-time risk monitoring, banks issue margin calls in the middle of the day. If you don't wire the cash in an hour, they liquidate you. This creates flash crashes. We are seeing more and more of these sudden air pockets where a stock drops 10% in a second and then bounces back. These are the tremors of a fragile market structure. The algorithms are testing the liquidity and finding it empty. In the final part of this investigation, we will open the remaining doors fully, and I will give you the master key, which is the specific signal to watch in the credit default swap market that tells you the collapse has officially begun.
We will also discuss the one asset that has historically survived a liquidity crisis, when even gold gets sold. The steamroller is moving faster, and there is nowhere to run, because the road is blocked by the very leverage that fueled the rally. We are now watching the credit default swaps, specifically the CDX North American High Yield Index. This is the insurance policy against corporate defaults. For 2 years, it was asleep, trading at levels that implied zero risk. In the last 48 hours, it has started to curl upward. When this index breaks above 500 basis points, it is the mathematical confirmation that the cycle has turned. The insiders are buying insurance because they know the house is made of wood and they smell smoke. Now let us address the final piece of the puzzle, which is the psychology of the freeze. In every crisis, there is a moment where rationality evaporates and is replaced by the primal need for cash. We call this the Minsky moment. It is the point where a stable system becomes unstable purely because it was too stable for too long. Investors took on too much debt because they felt safe. Now that safety is gone, they are rushing for the door all at once. But the door in private credit is locked. The door in corporate bond ETFs is jammed. And the door in the stock market is wide open, but only at prices 20% lower than today. This is why the crisis manifests as a gap down. The price does not drift down, it teleports. You close your laptop on Friday feeling rich,
and you open it on Monday feeling poor because the liquidity vacuum sucked the value out of the asset over the weekend. Now let us formally unlock the 3 doors, so there is zero ambiguity. Door number 1, the silent trigger. It is the repo rate spike combined with intraday margin calls. When the cost of funding the leveraged trade exceeds the return of the trade, the machine reverses. The algorithms sell automatically. There is no human intervention.
It is a code-executed liquidation. Door number 2, the patient zero. It is the multi-strategy hedge fund complex, specifically the pods levered into the basis trade and private credit. They are the new banks, but they are unregulated and fragile. When they unwind, they take the treasury market down with them, which takes the economy down. And door number 3, the ghost metric. It is net liquidity velocity. The Fed sees the static pool of reserves and thinks we are safe. The market feels the lack of movement and knows we are starving. The money is stuck in the pipes. And this brings us to the master key. The single concept that explains the coming storm is correlation convergence. In a normal market, stocks and bonds and gold and crypto move independently. They are uncorrelated. In a liquidity crisis, the correlation of all assets goes to 1. Everything moves together and everything moves down. Why? Because when you have a margin call, you do not sell what you want to sell, you sell what you can sell. You sell the gold to pay for the bad bond bet. You sell the Apple stock to pay for the private credit capital call. This is why diversification fails, exactly when you need it most. The only asset that has a correlation of 0 in a crisis is cash and volatility. Buying the VIX is the only true hedge against a liquidity event because it measures the fear itself. So what is the survival guide for December 2025? First stop, reaching for yield. The extra 2% you get from a corporate bond is not worth the 100% risk of principal loss. Second, cash is not trash. Cash is a call option on every asset class at a distressed price. When the liquidation happens, cash becomes the most valuable asset in the world because it buys the wreckage. And third, watch the gate announcements. When the big private equity giants announce they are limiting withdrawals for the 2nd quarter in a row, that is the bell ringing.
That is them telling you the liquidity is gone. Do not listen to the press release. Listen to the terms and conditions. The financial system has built a magnificent skyscraper on a foundation of quicksand. The engineers are telling us it is solid, but the geologists are packing their bags. I am watching the repo rate every single morning. If it spikes, I will issue the alert. This is not financial advice. This is a map of the minefield. The steamroller is here. Step off the road. End of transmission.